Hello and welcome back to Principles of Accounting 1. I'm still your host, Dr. B. We just wrapped up a wonderful conversation on inventory uh, and merchandise businesses. We are going to continue that conversation and we're going to continue talking about inventory and cost of goods. And moreover, we're going to be talking about how to value the inventory by looking at first in, first out, last in, first out, weighted average to value the inventory. And we'll talk a little bit more about how goods are in transit and things like that, very similar to what we just talked about in the previous chapter. So again, just as a fast recap where we are in the classroom, we are in Module 2 now, in week 3. We already talked about Chapter 5, and now we're going to talk about Chapter 6. For this Sunday, you'll have a Chapter 5 quiz and Chapter 6 homework assignment. Both have 5 questions, mix of true, false, multiple choice. And you'll have 2 attempts for each one. The higher of the grade highest attempt of the 2 will be accepted in the grade point. So, okay, let's go ahead and jump back into our conversation on inventory. So let's talk about cost of inventory and the value of inventory is really what we're going to be talking about in this discussion. Okay, inventory. Earlier I had mentioned that the cost of inventory is not just the purchase price. Okay, it's more than that, because it also takes a cost to get the inventory to you. That's the transportation cost, yeah? And then there might be some discounts, there might be some other stuff that equal the total cost of inventory. So it's important that we understand all of the different things that happen with an inventory. We got goods in transit, that's when it's on the truck. We got what's called goods on consignment. And then, of course, we also have goods that are damaged or obsolete. The word consignment. Some of you may have visited what's called a consignment shop. Okay, consignment shop. The word consignment means that I will not charge you the cost of the inventory until it is sold. Until it is sold. So a consignment shop works the same way. A consignment shop is where it's a store where you go in and they sell a lot of various things, mostly clothing and some other things. It's used clothing typically, and it's used goods, right? You go in and you'll see a sticker on it, and usually there's like a small number and then the amount. The way it works is that people will give that stuff to the consignment shop, and they'll say, hey, sell this for me, right? The consignment shop will sell the stuff, and at that point, that's the time when the consignment shop will, have cost of goods sold, and then they'll give some portion of the proceeds to the original person that owns the merchandise. That's what consignment means. I'll go into more detail, but that's the general sense of it. And then if goods that are damaged or obsolete, we know what damaged goods are. That's when it's defective, don't work right, whatever. Obsolete means a new product has replaced that product. Okay, iPhone 11 was replaced with iPhone 12. Samsung 22 replaced Samsung 21. Samsung 21 and iPhone 11 are considered obsolete. Obsolete means we can use them, but they're no longer relevant. Yeah, they've been replaced by something newer and better. Absolutely. Goods in transit. We've talked briefly about this already. Free on board shipping point means that the buyer is responsible for the goods while they are in transit to the buyer. That also means that the buyer pays for the shipping cost. Typically, they just add it to their cost of goods, yeah, to their inventory value. Free on board destination means that the seller is responsible for the goods until they reach the buyer. Free on board destination, the seller records the cost as transportation expense and then the credit cash. We talked about that in the last chapter. Goods on consignment. I gave you the example of the consignment shop. The consignor are the owners of the goods. Okay? If I am bringing stuff to a consignment shop to be sold, I am the consignor. I own those goods. The consignee, the consignment shop, sells those goods for me. Okay. The merchandise is on the inventory of the consignor. It's my inventory. I own it. Although I'm not selling it, I own it. Okay. So that's my merchandise that I'm selling. So I'm responsible, the consignor is responsible for the merchandise until it's sold. The consignee, the consignment shop, never reports cost of goods sold on their inventory or the cost of goods on their inventory because it's not their inventory. Yeah. Consignee, that's just the store. Consignor, they own the inventory. Consignee is just the store. Okay. The store is not responsible for the inventory. The consignors are in a consignment situation. Damaged goods, we know what those are. You know, defective. They can either be sold or not sold, but usually not, you know. Damaged or obsolete goods are not reported in inventory if they cannot be sold. Why would I have something in my inventory if I can't sell it? I wouldn't. Damaged or obsolete goods which can be sold are included in inventory at what we call net realizable value. Now, sometimes I can sell damaged goods. I can sell a broken, or well, not broken. Let's say I got a refrigerator I'm selling and it's dented. Just because it's dented doesn't mean it don't still work. It still works. It's just dented. Okay? So it's damaged, right? I can still sell it, but I'm going to sell it at a reduced cost. I'm going to sell it at its net realizable value. Okay. The same can be said with something that's obsolete. I can still sell the iPhone 11, okay, but I'm going to sell it at a lower cost than the iPhone 12 because the iPhone 11 is obsolete. Still works just fine. Still works like it's brand new because it is, but it's obsolete. So I'll sell it at its net realizable value. The net realizable value is the sales price minus the cost to sell that product. So the net realizable value for the refrigerator might be like, I don't know, $300. That's the cost of the inventory itself, yeah, at its current net value, which includes the fact that it's damaged. The iPhone 11, I'll sell that, the cost of it, sales minus the selling cost, might be like $300. The $300 represents the cost of the product, okay, for me to sell it. I'll still sell it for like $600, but the cost has gone down. If there's a loss recorded, I'm sorry, a loss is recorded if it's damaged or obsolete in some way. Cost of goods. As I had mentioned earlier, it's not just the purchase price. When I sell inventory, the cost of that inventory is not just the purchase price. It also includes other costs. So it's the purchase price, also known as the invoice cost, minus any discounts that I got, that I got from my vendor, plus my other costs. My other costs can include, but not limited to, shipping, storage, insurance, and import duties. Shipping, that's the transportation cost to get it to me. Storage, if I have to keep it in a warehouse somewhere, I need to pay for that warehouse, yeah, storage. Insurance. Oftentimes, we have insurance on the shipping. I'm going to insure it to be shipped. If something happens to the truck while it's coming to me, insurance covers it. Or I have to insure it while it's sitting in my warehouse. And then import duties. Import duties are the taxes that we pay when we import inventory from other countries. So if I'm going to sell a product and that product is made in somewhere else, we'll say it's made in Brazil, okay? The product's made in Brazil. I am going to purchase it from Brazil. When it comes to the United States, I might have to pay import taxes. We call these import duties. That'll be added to the cost of my inventory. So it's the inventory cost itself, the purchase price, minus any discounts, plus other costs like shipping, storage, insurance, and import duties. Or duties simply means taxes, yeah. It's important that we protect our inventory. We got to protect our inventory. You don't want somebody taking it. You don't want it something happening to it. You don't want it catching fire. We got to keep it safe, yeah? So we implement what we call a set of internal controls. And we also do a physical count of inventory. Almost, I don't want to say every business because I can't speak for every business, but most businesses take a physical count of inventory at some point in time. You go to Macy's and you see all these like tags, okay, around the store. And it'll say some other company's name on it, yeah. They're doing inventory. That's what that means. Okay. They're taking a physical count of inventory. That's how they track what they've already counted, yeah. So usually once a year, sometimes more than that, we'll take a physical count of inventory. It's where we go to every shelf, we document what it is and how many there are on that shelf. That's a physical count of inventory. If for whatever reason that physical count of inventory does not match what you have in your accounting system, you need to make an adjusting entry for the difference. Yeah. And that goes against your cost of goods. Yeah. For internal controls, there's a lot of different things we could do. Oftentimes valuable inventory is locked up in a safe or behind the counter or whatever. Yeah. valuable inventory will be tracked that way. We separate duties and responsibilities between individuals. So I might have one person receiving inventory from the vendor, separate from the person who's counting the inventory, who's also separate from the person who are making the sales. You know, separation of duties. These are methods for internal controls. When we look at our inventory, we assign a value, a cost to that inventory. And there are 4 methods. We select one of the 4. You cannot use all 4. In fact, you can't even use more than one. It has to be one method, and you have to stick with that method for your own company. Okay? So for those of you who own your own business, you have to select one of these 4 if you're selling inventory. Okay? This helps you to assign the cost to your inventory. There are 4 methods. One is called specific identification. Specific identification. This method is used by a very small amount of companies throughout the world. Specific identification usually means there is a serial number attached to the inventory. An example of that, a car. A car has a VIN number, vehicle identification number. That is a specific identification. Okay. So they track cost of goods sold based off of each unit. Specific identification. The second method is called the first in, first out method. First in, first out method. This is used by about 48% of companies throughout the world. It's probably higher than that now. It's probably 50. First in, first out. Here's how it works. A grocery store will use the first in, first out method. The reason for this is they want to sell what they received in first. Okay? If I'm a grocery store, I purchase oranges from my vendor. The oranges come into my store. I want to sell those first. Why? Who can tell me why?
So they won't be wasted?
Yeah, they rot. They get wasted, exactly. They expire. A lot of things have expiration dates on them. Almost all groceries do, even frozen ones. Yeah? So, frozen stuff, anything you get from a grocery, we call that perishable. It perishes. It will expire. It gets old. It gets gross. You throw it out. Okay? That's why grocery stores, when they stock the shelves, you'll notice that whatever's up front expires sooner than the stuff behind it. That's why your mom always said when you go to the grocery store, reach in the back of the cooler. Reach in the back of the cooler to get the milk, yeah? The milk in the back of the cooler, on the back of the shelf, will expire later than the ones in the front. Yeah? That's why they do this. Yeah? First in, first out. The third method is called the last in, first out method. Okay, last in, first out method. This is used by about 28% of companies throughout the world. Last in, first out means it just arrived and I'm going to sell it first. Okay. Examples of companies that use the last in, first out method include companies like Macy's, Best Buy, you know, companies like that. The reason why is because electronics don't have expiration dates on them. Okay, it doesn't matter. I don't care if I sold this first or last. It doesn't matter. Okay? It's not going to expire. Last in, first out. So think Best Buy, last in, first out. And then the fourth one is called weighted average. About 20% of companies throughout the world use weighted average. Weighted average represents the average cost of the inventory throughout the time period. Okay. The way it works is that I can make multiple purchases of inventory throughout the year from my vendor. And all I'll do is I'll add up all the purchases and divide by the number of purchases to get the average. That's how I get my average cost of inventory. About 20% companies use this. The reason why only 20%? It's a little bit more complicated to use. It's really that simple. Let's talk about each one a little bit more detail. So first in, first out. Let's talk about first in, first. We won't talk so much about specific identification because that's very straightforward. Think vehicle identification number, think serial number. It's tracked to that product. That's why it's specific identification. Let's talk about the other three. First in, first out. So thinking about the grocery store example. I purchased the oranges from my vendor. I'm going to sell those oranges first. Yeah. Before the other purchases arrive. Because they expire at some point in the future. So that's why first in, first out is most commonly used. The way it works is that for the cost of goods sold, I record the first purchase amount. I record the first purchase of inventory amount. That's going to be my cost of goods sold amount. Again, the reason for that is because whatever came in first is what I'm going to sell first. First in, first out. So the way it works is for the cost of goods sold, it'll be the first purchase that I made, yeah? In this example, I made a purchase of oranges for $45 on May 1. I made another purchase of oranges on May 3rd for $65. And a third purchase of oranges on May 6th for $70. According to the first in, first out method, I need to sell whatever came in first. That would have been the purchase for $45 I made on May 1. May 1 comes before May 3, obviously. So $45 is going to be my cost of goods sold because that's what I'm going to sell through first. I take my sales minus my cost of goods sold equals gross profit. So my cost of goods sold, I record that as $45. On my balance sheet, I have the remaining balance of my inventory, my oranges, right? So for my oranges, I have an inventory of $135. How did I get $135? Because I see more than that through the three purchases, right? Well, that's because I already sold $45 worth. So I sold $45 worth. That's my cost of goods sold. First one in was the first one out. The remaining balance, that's why I call it a balance sheet. The remaining balance represents my balance for inventory. The remaining balance would be the May 3rd purchase of $65 and the May 6th purchase of $70. That gives me $135. So 65 plus 70 is $135. So using the first in, first out method, I have a gross profit of $55, sales minus cost of goods sold, and I have an inventory balance of $135. Everyone good so far? First in, first out's very clear, straightforward. So maybe questions on first in, first out? Good so far, yeah? Okay, cool. Thank you. Let's talk about the second method, sip of coffee. Last in, first out. Best Buy. Best Buy. Last in, first out. Because again, it doesn't matter uh, at Best Buy in the order I sell my inventory because electronics don't expire. So Best Buy uses the last in, first out method. What that means is the last purchase I made during the accounting period will be the cost of goods sold for the accounting period. In this example, I made 3 purchases. May 1, $45 worth of electronics. May 3rd, $65 worth of electronics. And May 6th, $70 of electronics. These were the 3 purchases I made during the month of May, the accounting period for May. So I take the last purchase, last in, first out. The last purchase is the cost of goods sold. Remember, the last one that came in, purchases May 6th, is the first one to go out, which means that will be my cost of goods sold. In this example, $70. Sales of $100 minus the cost of goods sold, $70, gives me a gross profit of $30. The remaining balance is my inventory. I made 2 other purchases before the one I sold for $70, yes? So I take $45 from May 1, $65 from May 3rd, to give me $110 is my inventory balance. So, okay, net sales minus cost of goods sold equals gross profit, $30. That's right. This is right. And that's probably what Best Buy would look like. I mean, obviously the numbers would be a lot bigger, but you see my point. The third method is called the weighted average method. Again, it's not used by a whole lot of companies because it gets complex. I mean, yeah, there's only 3 purchases here, but we already know it's going to be more than 3 on average. So weighted average. It sounds exactly as it is. We add up all of the purchase amounts, $45 plus $65 plus $70. That's $180. We take the $180 of purchases that we made throughout the accounting period and we divide that by the number of purchases throughout the accounting period. This example 3. 180 divided by 3 is $60. That's our average. That's our weighted average, yeah? I sold 1 unit, okay? For $60 was my cost. Sold it for $100 minus $60 cost of goods sold equals gross profit of $40. I have 2 remaining purchases left in inventory. 60 times 2 is 120. That's my inventory balance. Everyone sees how we got here? Makes sense? Clear? To the point?
Yes, it definitely makes sense, Professor, but I'm just trying to process it into the whole bigger picture. So these transactions are, one by one, but clearly, in a period they would add up, correct? Okay.
Yeah, that's right. There will be a lot more than just 3. I'm pretty positive of that. There might be hundreds, there might be thousands. It depends on how big the company is. Uh, like that Best Buy example, I'm pretty sure they're making more than 3 purchases in 1 month. There's probably like 1,000 purchases in 1 month or more than that. Same with the grocery store. There might be hundreds, but the same
Right. So
concept
they would
applies.
right. So they would probably more than likely group all of the inventory into, and then log it like that in
Right.
what group it belongs in how it should be sold or a time frame
That's correct.
to be sold.
That's how
Okay.
it would work in the real world. Yes. Yeah. Excellent point. Good. Very good. Okay, so those are the three methods. There's technically four, but those are the three. You've seen this slide before. We talked about this one in the last chapter. Inventory has a flow, as we just saw, right? First in, first out. Comes in, it leaves first. Last in, first out. The last one purchased is the first one I'm going to sell. And then the weighted average. You know? But we see that from those examples, there's a physical flow of the inventory. It's coming in, it's going out, etc. So we come up with what's called merchandise available for sale. We take the beginning inventory. That's the beginning balance of inventory that we started with at the beginning of the month. Okay, that's what we already have on hand at the beginning of the month. That's our beginning balance inventory. Plus net purchases. Again, net purchases represents the purchases that we made from our vendors minus any discounts. That's our net purchases amount. Equals merchandise available for sale. Merchandise available for sale represents ending inventory plus cost of goods sold. That's the physical flow. Earlier, we talked about having two inventory systems. The perpetual, which means continuously updating, and the periodic, which means we do a physical count. Okay. Perpetual inventory system is the most commonly used. Thinking about the grocery store example for first in, first out, we scan the barcodes from the fruits and vegetables and all of the boxed goods and everything at the grocery store usually has a barcode on it. Sometimes we weigh things, but you get my point. The grocery store uses a perpetual inventory system. And I want to show you how to compute first in, first out, last in, first out weighted average using that perpetual inventory system. So perpetual inventory system, I'm using the scanner and it's updating my balance sheet, ending inventory, and it's updating my cost of goods sold every time I scan the barcode. Those are the effects it has on the inventory. Here's an example. This company makes mountain bikes. Okay. That's cool. Mountain bikes are fun. It's been a long time since I've been on one. I was probably like 12 last time I was on one. So here's an example. We started out our month, August 1st. We had beginning inventory. We had 10 bicycles in our store at a cost of $91 a piece, giving us a total inventory cost of $910 at the beginning of the month. Then a couple transactions happened. I purchased more bicycles from my vendor. I purchased 15 more bicycles on August 3rd at $106 a piece, giving me a total cost of $1,590. So I added that 15 to the 10 units of inventory. They're on the right side. That's what I got going on. Then I sold a few bicycles. I sold 20 of them at $130 a piece. Great. I sold 20, so I got to reduce my inventory by 20. I had 25 units on August 3rd total. I sold 20 of them. Now I'm down to 5. So I got to purchase more bikes. I only got 5 left. I got to purchase more. I'm going to keep selling. August 17th, I purchased 20 more bicycles. This time it cost me $115 a piece. It's probably inflation, It's got to be inflation. So $20 a unit. I'm sorry, 20 units at $115 a piece for a total of $2,300. So now I'm back up to 25 units that I have available for sale. And I said, oh, you know what? That's not going to be enough. I need to purchase some more. So I purchased 10 more units. This time it cost me $119 a piece. A piece. $1,190. Now I'm up to 35 units available for sale. On August 30th, I sold 23 bikes at $150 a piece. Not bad. That brought me down an ending balance of 12 bicycles left. Throughout the month, I had 55 bicycles coming in and out. I'm sorry, I had 55 bicycles that I purchased throughout the month. At a total cost throughout the month of $5,990. And throughout the month, I sold 43 bicycles. 55 minus 43 is 12 bicycles ending inventory balance. Total goods available for sale, which represents all of the purchases I've made, 5,990. So that's the information we have available. Now let's talk about the value of inventory. First, we'll do specific identification. Then I'll walk you through first in, first out, last in, first out, weighted average. Specific identification, as I mentioned earlier, has to do with the specific bicycles in this example. Okay. I got 55 bikes available for sale throughout the month. My cost of goods sold on August 14th and August 30th. I add those up. I take my cost of the 55 bikes available for sale minus the cost of goods sold for the month to equal my ending inventory, 1,408. Again, that's specific identification. I'm grouping, the specific bikes together. That's how specific identification works. First in, first out.
Hold on, Professor, because I really quickly, I just wanted to confirm did or did not, because I would think that he would represent the number of purchases that he made, but it seems like this is more than the number of purchases he made.
No, you're right. So this represents the cost of goods sold, which accounts for kind of the purchases he made, because we can see August 14th. I'm sorry, 8 at $91, 12 at 106. If we go back, he's selling some of the beginning inventory, 8 out of the 10 at $91, and then selling 12 at $106. So some out of this batch. Sold those on August 14th. And then on August 30th, sold the remaining 2 from the beginning balance. Sold 3 more from that first purchase. Sold 15 more from that second purchase. And sold 3 more from that last purchase to get the cost of goods sold. This is specific identification, which means that we can sell out of any of the lots, any of the purchases that we've made. That's what specific identification means. It's specific to that unit. And so in this example, it's specific to that purchase. And so I sold 8 out of my beginning balance, 12 out of my first purchase, 2 more out of my beginning balance, 3 out of my first purchase, 15 out of my second purchase, and 3 out of my last purchase. It looks sporadic, and the reason for that is because it's specific identification. I'm specifically selling whatever, out of those areas. Does that make sense?
Okay. And do they generally pick 2 dates out of the month to express these, I guess,
No, so,
transactions?
so
Okay.
good question. So these 2 dates that we see here, August 14th and August 30th, are the dates that I made sales. Okay, these are the dates I sold bikes on, and so I'm just selling through whatever on those dates. So I sold from my first purchase, I sold from my second purchase, so forth and so on these 2 dates. The dates, it doesn't really matter so much because well, these 2 dates here we see are the 2 dates I made sales on. But in practicality, I would just do it at the end of the month. Uh, but to your point, it could really be any dates that the sales are being made on. It looks to me like they're being grouped on those 2 dates, and that's probably the case for this company.
Right.
Yeah.
You're right. And I just was, because I didn't read the chapter first. Just
Okay.
wondering if that's the general, outline, or,
No, it's
could it be
not.
a little. Okay.
No, because on a normal, I'm going to say normal company, on a average company, you'll see that they make sales every day, or they'll make sales a few times a month or whatever. It's whenever those sales are made is when you'll see that type of grouping. Yeah, good question.
Thanks, Professor.
My pleasure. So with first in, first out, as you know, I sell the oldest. I sell the newest item first. Yeah, first. I'm sorry, oldest item first. Whatever came in first is what I'm going to sell first. Okay, and the reason for that is because uh, things are perishable. Like a grocery store items. So first in, first out. This is how we assign the costs in the inventory system, the professional inventory system. The oldest costs of first purchases are assigned to the cost of goods sold. The most recent purchases, recent costs, are assigned to the ending inventory balance. That's what we saw a few slides ago when we were talking about the 3 different systems side by side. So using our same example, we started the month 10 bicycles, $91 a bike, 910. We made some purchases, purchased 15 more bikes, $106, $15.90. You see where we're going with this? We're adding them up. And then we sold some, right? August 14th. Take a look at the sales. We sold 20 bicycles on August 14th, as you recall. The first in the 10 bikes at 91 was the first out. I sold that batch first. And then I sold this part of the second batch of purchases. I sold 10 bikes out of the 106 purchase, which means I would have 5 left at 106. First in, first out. So I sold August 14th, first in, and then that whatever else I had that came in after that to equal the 20 bikes sold. So 10 at 91 and 10 at 106 because I only sold 20 bikes on August 14th. I add those uh, cost of goods together to get total cost of goods sold 1,097 for August 14th. My remaining balance, 5 at 106. Why 5 at 106? Because I still have 5 left from that first purchase at $106. Yeah, gives me inventory balance of 530. And then, we had to purchase some more. We had to purchase more bikes because we're selling through quickly. So we purchased 20 more at $115. So I added that to my balance. I had the 5 at 106, and then I had 20 at 115. And then I purchased another 10 bikes at 119. So I had my 5 from before, my 20 from before, and then I added 10 more to get an inventory balance of 4,020. And then I sold more bikes. I sold, how many bikes did I sell that day? It was 18, 19, 20, 21, 22, 23. I sold 23 bikes, I guess, something like that. So I sold 23 bicycles on August 30th. Using the first in, first out method, I'm going to sell what I had first, remaining, right? So 5 at 106 would have been what was remaining. And then I'm going to sell 18 out of that second, second purchase. 18 at 115, together 23 bikes, equals 2,600 cost of goods sold for that day. And so at the end of the month, what we do is we add up all of our cost of goods sold, in this example, 4,570, and my remaining balance be 1,420. Good so far? And that's a lot of information at once.
Yes, I just want to make probably another obvious observation.
Go for it.
We are logging the purchase price, not the price we are selling the inventory for,
Right.
but the price that we purchased for. Okay.
That's correct. Yep. You're selling it, your cost of goods sold is your cost of the inventory that you're selling. Is your cost of the inventory that you're selling. So the purchase price, yes, that's correct. In real life, the cost will probably be a little higher because I would imagine that there would also be other costs other than just the purchase price, right? But to keep the example simple, that's why we have it recorded as purchase price. Good question. Okay, so that was first in, first out. Now let's take a look at last in, first out. Think Best Buy, okay? So the electronics, the most recent cost, the last purchase, is recorded as the cost of goods sold. And the first purchase, the oldest costs, are recorded as the inventory. Or first purchases, I should say. And again, going back to that one slide from the previous, several slides back, I guess, where we had them side by side, it works the same exact way. So last in, first out. So according to the last in, first out method, I'm going to sell the last amount first. Now the beginning balance is always the same. The purchases will be the same, but I want you to look at the sales. So August 14th, the first batch of sales that I recorded was 15 bicycles at 106. Now you might be asking, well, what? Because that's the last purchase I received in. Last in. Last purchase I received in were 15 bikes at 106. So I'm going to sell those first. Last in, first out. And then I'll sell, whatever the balance is from my beginning balance. Okay. to get up to the 20 bikes that I sold on August 14th. Take a look at the cost of goods sold. It's $2,045. Obviously, that's different from first in, first out. Our remaining balance is 5 at 91 bucks because, again, last in, first out. Gives me inventory balance of 455. And then I made my purchases just like I did before, August 17th, August 28th, same amounts. What's different is the inventory balance. And the reason why the inventory balance is different is because I still had 5 units left from my beginning balance. Because I sold my entire first purchase and then 5 from my beginning balance. So I added August 17th, August 28th. And now my inventory balance on August 20th is $3,945. Now August 30th rolls around. According to last in, first out, whatever I most recently purchased is what's going to go out. So last in was 10 bikes at 119. I'm going to sell them first out. 10 at 119 is 1,190. And I'm also going to sell whatever from the purchases before that most recent one. Would be 13 bicycles, because remember I'm selling 23 bikes on that day. 13 at 115 would be 1,495. I add those two together to get my total cost of goods sold for that day. And I add up all my cost of goods sold, 4,730. And then take a look at the inventory balance. I still got those 5 from the beginning, and then I have 7 left from that second purchase. And to get me a total of 1,260. Good so far? Well, it's a lot of information. Asia, makes sense? We good? All right. A lot of information. Sure is. Okay. So we talked about first in, first out. We talked about last in, first out. Now let's talk about weighted average. Weighted average, while simple, it's always not the most accurate, which is why not a whole lot of companies use it. Weighted average. We take the cost of goods available for sale divided by the number of units on hand at that date. Very, very simple, yes? Take the cost of goods available for sale, $2,500. We divide by the 25 bicycles that we have on hand on that date to give me a weighted average cost per unit of $100. Very, very straightforward. So to get my cost of goods sold on the date that we made the sale, we take the 25 bicycles and the 2,500 inventory balance, divide by the 25 bikes, get $100 per bike. I sold 20 bikes at $100 cost of goods per bike. Again, weighted average. I will do the same thing for the next sale date as well. So on August 17th, I got another 20 bikes in at 115, which brings me up to 25 bicycles for August 17th, 5 plus the 20. The cost of goods is 2,800. divided by the 25 bicycles on August 17th. It gets me a weighted cost per unit of $112 per bike on August 17th. So when I make my sale, on August, well, then I got the next purchase, right? So $112 per bike, 25 bikes. I bought 10 more at 119, which brings me to inventory balance of $3,990. I take that amount and divide that by the 35 bikes I have available for sale on August 28th. Give me a weighted average per bicycle of $114. And eventually we'll make it to August 30th. August 30th, we're here. We sold 23 bicycles at a average cost of $114, bringing us total cost of goods sold for the day of $2,622, for a total cost of goods sold for the month of $4,622, and my inventory balance was $1,368. Now we can see here at the bottom, we have a really good way of showing you how this is computed. We take the inventory balance divided by the number of units available for sale on that day. And that's how we find the weighted average, basically on a per day basis, right? And we take that weighted average when we sell, we take the number of units sold times that weighted average. They give us the cost of goods sold. Now, the real reason why companies select one over the other, taxes. that's the real reason, right? Uh, Now, why? You might be asking, why would a company select one of these three based on taxes? You might be asking. Well, it's simple. With higher costs of goods sold, the lower your net income is. Think about it. You make the same amount of sales, but if your cost of goods sold is higher, that means your gross profit's going to be lower, right? Minus all your expenses, you're going to have a lower net income. Taxes are based on net income. So the lower your net income, the lower your tax bill is going to be. Right? So that's the real reason why companies select one of these three methods. For first in, first out, the ending inventory approximates the current cost. Yeah, and that's why the majority of businesses use first in, first out. But also because the majority of businesses have perishable items. Last in, first out, the effect of using that is that the cost of goods sold on the income statement approximates its current cost. Yeah, absolutely. I will also say that it's probably, in my opinion, the most accurate one to use. It's just my opinion. Then the weighted average smooths out percent price changes. That's the effect. Yeah. It does, but it's not always the most accurate. So looking at our example, our bicycle example, we can compare the four methods: specific identification, first in, first out, last in, first out, and the weighted average. And in this comparison, and also looking at what happens to the net income, the net income varies, obviously, significantly between specific identification, first in, first out, last in, first out, and weighted average. The highest is under first in, first out net income. Right? You would think in business, having a higher net income, that's a good thing. And it is. It is a good thing. Yeah. Um, Sometimes not, because we got to pay more on taxes with a higher net income, which is why some businesses prefer to use other methods. And then with respect to the inventory, well, you see the inventory valuation correspond accordingly. So first in, first out, 1420. Well, last in, first out, 1260, and weighted average 1300. Well, we see the effect, yeah. And we also know that in business, taxes have an implication as well. Brianna, almost. Brianna has a question. And it's, accounts receivable is when customer promises to pay an amount for a service not yet rendered. So now, almost. It's for a service that has already been rendered. So the account receivable gets generated when we've already provided the good or the service, but they have not yet paid us. Okay? So accounts receivable is when we've provided the good or the service, but they have not yet paid us. It's a promise to pay us in the future. Good question.
Okay, okay. I get it now.
All right, cool.
Thank you.
You're welcome. So, as I mentioned, the effect and the real reason why companies select one of these four methods over others for their inventory valuation has to do with the taxes that they pay. But for the majority of the companies, they use first in, first out. But for tax reasons, last in, first out is what's commonly used because it's required by the IRS. Uh, Lower cost of market. This last concept I want to talk about is called the lower of cost or market. Okay, inventory needs to be reported at what we call its market value. Its market value. Okay. Market value is sometimes lower than its cost. Okay. This is also known as its replacement cost. And this gets reported based off of individual items, or if there's major asset changes, or to its whole inventory. The lower cost of market, lower of cost or market, I always have trouble saying that for some reason, represents the cost in comparison to the market cost. And if the cost is lower than its market cost, we call that its replacement cost. And this is what this example shows us. Sometimes we need to make adjusting entries for inventory, right? And it happens for a number of different reasons. It could be shrinkage, it could be damaged goods, it could be some type of loss or whatever. But sometimes we need to make adjustments, and those adjustments have impacts on our cost of goods sold and on our net income ultimately. If the ending inventory is understated because of whatever reason, oh, I lost some items or whatever, I found some items, it will ultimately lead to overstated cost of goods sold, which means you're understating your net income. That's problematic, yeah. If your ending inventory is overstated, meaning you're saying I have more ending inventory than what I actually have, that causes cost of goods sold to be understated and your net income to be overstated, which is also problematic. So those errors happen for various reasons, and so we make adjusting entries to fix them if something like that happens. This kind of shows you the effect. Yeah? And the effect on the balance sheet is if the inventory is understated, it understates your total assets and your total equity. If it's overstated, it'll overstate your total assets and total equity. So, we can't end any lesson without a couple of ratios, I guess. It's important to understand ratios because it helps us as managers and investors to understand the financial health of the company. And it also tells me about their performance. One of those performance measures is called the inventory turnover ratio. This tells me how quickly the company is selling through their inventory. Yeah, very good. It's a very good measure. We take the cost of goods sold divided by average inventory. Anytime you're looking for the average of something, we take the beginning balance plus the ending balance and we divide by 2. Another good measure tells us how long something is sitting in inventory. That is called the days sales in inventory measure. We take the ending inventory balance on our balance sheet divided by cost of goods sold on our income statement times 365 days. This tells me how long something is sitting in our shelves. As a manager, I might tell you if you need to discontinue an item or if it's sitting there for too long, you might not want to have it around. This shows us an example from Costco for the current year, last year, and the year before. Yeah, it's interesting. Okay, and that ends our discussion on inventory. Are there any comments, questions, or concerns about inventory? Or something you were hoping we would cover but did not? Y'all good? All right, cool. Okay, so just to quickly recap, in the classroom for this Sunday night, you owe me the Chapter 5 quiz and the Chapter 6 homework assignment. They're both 5 questions, true, false, multiple choice. They both, you have 2 attempts on each one. The higher the grade will be accepted in the grade book. Nice, straightforward, easy to the point. My recommendation, of course, is to look through the PowerPoint presentations, read through the chapter. Definitely try the exercises. Just like what Asia said earlier on, those exercises can be really helpful. It's called practice exercises by topic. If you open this up, and you can look at the concepts we just talked about. Some of these are really, really helpful. Again, practice is something that will certainly help you to really understand and grasp the concepts. So looking at some of these, I think will be helpful for you. It's just my recommendations. Just think about it. With that, are there any other comments, questions, or concerns that I can help to address at this time? Everyone's good, huh?
I actually did have a question. I'm not sure if I'm at liberty to ask it. It was regarding our last quiz. It was about the accounts receivable and payable, I believe.
Okay,
Um,
sure.
I can ask it, or should
Go
I
for it.
wait? Okay.
Yeah.
It was question 5. It was very tricky for me when I did the math. The math told me that the debt salaries payable were 10,800 and the expense was 7,200. Um,
Which question was it? I'm sorry.
it was question 5. It was the one where S company had 10 employees.
10 employees. Oh, yep, I got you. Okay. So
When
10
I did it,
employees.
it told me that the answer was wrong, but I kept doing it over and I kept coming to the same answer.
Okay, I got you. So two things. Two things with this question.
Okay.
First is the question is asking us, the amount. Obviously, we got to find the amount, which we
Right.
determined to be 10,800.
Mhm.
The second part of the question is what gets debited and what gets credited.
Right.
In order for us to accrue an expense, we debit the expense and we credit the payable. And that's where most students probably get tripped up, is because we're talking about the adjusting entry. When we make adjusting entries, we're typically making either a correction or we're making an adjustment to recognize the accrual that has taken place at the end of the accounting period. So in this example, we got 10 employees earning a total of $3,600 each day. Yeah. So 3,600 per day.
Mhm.
They work 5 days. So if they work the 5 days, so let's see, 3,600 times the 5 days is 18,000.
15,000. Yeah, that's what I came up with too.
The 18,000 work the 5 days. We assume, and this is where the tricky part comes into place, okay? Because this is
Mhm.
where the adjusting is. We assume the year ended December 31. It's a Wednesday.
What was that?
It's a Wednesday. Okay, so that means only 3 days.
Right.
Yeah. And the salaries for the 5 days will be on the following Monday. Okay, we don't care about that part. That's just extra fun.
Mhm.
We care about the 3 days though. So really, we're only accruing the wages for 3 days for this adjusting entry that we're making on December 31.
Right.
So 3,600 times the 3 days is 10,800.
Mhm. Yep.
So we debit salaries expense 10,800 to accrue the expense, and we credit salaries payable 10,800 to accrue the payable.
Okay.
And so that would give you your answer, which is A in this question.
Okay.
Does that
I
help to
guess that's
clarify?
where I guess that's where kind of like my confusion came in because although I got A, I I thought the expense was 10,800, and
Mhm.
then we would have to add or subtract those last 2 days for the. I don't know. Maybe I'm confusing myself.
No, you're getting ahead of yourself. So Brianna, let me help you with this. You're on the right track. So the first 3 days, we make the adjusting entry because it's the end of the year.
Right.
For the remaining 2 days of that week, we just make a second entry. But that second entry won't go in until the following year. You see what I'm
Right. Okay. 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 I think I was trying to put all 5 days together,
saying?
the whole thing together. Yeah. Okay. I
Yeah,
get it. I get it. Okay.
yeah. Cool. Excellent
Because that
question.
was the tricky part. I was like,
It
no, and I
was
did
a
it probably
tricky
like
part.
7 times, and I'm like, okay, I keep coming up with the same answer, but
You're
I'm
not the
not
only one that got
understanding
tripped
why
up.
it's the same.
Yeah.
Yeah. Okay.
Great question. I'm glad that you brought that up. That's a good one.
Thank you.
You're very welcome. Okay. Any other comments, questions, or concerns? Oh, good so far. Okay, great. So as a reminder, we have the chapter 5 quiz, chapter 6 homework. Both are due this Sunday night. 5 questions on each one. You got 2 attempts on each one. I'd recommend following the PowerPoint presentation. Feel free to rewatch this recording should you need it. And of course, read the chapter. Yeah. Recommend the exercises. Those are usually always helpful. And with that, if you ever need help, comments, questions, or concerns, you can email me, call me, set up office hours. whatever you need, I'm here for you 100% of the time. Email's always quick and easy. It goes right to my phone. Even if I'm out somewhere, I can quickly respond. But yeah, I just want to let you know that I'm here for you. You're all doing very well so far. If for whatever reason you fall behind, get caught back up quickly. Please, please, please. Next week, we'll have one more chapter and then the midterm exam, yeah? So I know, right? 4 weeks, 4 weeks, 4 weeks. So, yeah, if you ever need me, I'm here for you. Thank you all so much for your time today. Appreciate all of you. Enjoy the rest of your day, and I'll see you all again next week, same time, same channel. Thank you so much. Take care. Bye-bye.